Good evening, savvy savers and curious investors. Welcome to Capital Market Live on Channels Television. I am Will Ibong. Let's take a look at your local investments, how they fared this week. And for the month of August, we're the August 31st today. But first, let's have a sneak peek outside the country. We make a first stop in Europe, where European stocks had a bumpy month, but ended August at record highs. This surge comes as global markets grow more confident about a soft landing for the U.S. economy. Investors are optimistic that the Federal Reserve might start cutting interest rates in September, with the European Central Bank possibly following suit. Adding to the positive outlook, Eurozone inflation dropped to a three-year low, falling to 2.2% in August from 2.6% in July. This expected decline is seen as a good sign for the region's economy. Now, with lower inflation and the potential for rate cuts, investors have a reason to be optimistic, driving stocks across Europe to new heights. In Asia, markets got a boost on Friday as positive U.S. economic data eased recession fears. The good news from the U.S. lifted markets, while investors also focused on fresh data from Japan. In Tokyo, inflation rose to 2.6% in August from 2.2% in July, the highest since March, indicating faster than expected price increases. Tokyo's inflation is often seen as a predictor for Japan's overall economy, but this rise could signal broader trends. Investors are watching these developments closely as they navigate Asia's changing economic landscape. Now let's see how U.S. stocks ended on Friday. It was strong, with the Dow Jones hitting a new record high. The Dow rose 228 points, closing at 41,563 points, reaching an all-time high in the final minutes of trading. The S&P 500 gained 1.01%, closing at 5,648 points, while the Nasdaq Composite climbed 1.13% to end at 17,717 points. It was a solid finish to a volatile month. The Federal Reserve's preferred inflation gauge, let's look at that. The Personal Consumption Expenditures Price Index rose 0.2% in July and 2.5% year-on-year, in line with expectations. This steady inflation data helped boost investor confidence as the month closed. Now back home, positive sentiments returned to the local bus this week after 2 consecutive weeks of losses. The all-share index advanced by 0.63% week-on-week to 96,580 points, driven by strong investors' interest in O&O following the completion of the acquisition of the Nigerian Japaul company, as well as bargain hunting activities in Boa Foods. As a result, the month-to-date and year-to-date returns improved, but we still see negative performance for month-to-date, which is at 1.2%, and 29.2% for year-to-date. Meanwhile, market activity levels remained mixed as total trading volume declined by 50.1% week-on-week, while total trading value increased by 60.9%. Let's look at the sectoral performance. It was broadly positive as all key indexes recorded gains. O&O topped the gainers chart with a 60.7% increase, while the Transcorp Power led the decliners for this week. Consolidated Hallmark Holdings, Veritas Capital Assurance, and Access Holdings were the most actively traded stocks by volume this week. Now, to get the facts behind the figures, dissect what happened this week, and to look ahead, we have Mustafa Alao, Head of Investment Research at Investment One Financial Services, joining us virtually. Good evening, Mustafa. Good to have you join us today. Mustafa, let's just kick off with this week. We see the equities market inching back up, which inched back up higher by 0.63% week-on-week, increasing the year-to-date performance to 29.16%. However, month-to-date index is in the negative territory. Which sectors would you say contributed the most to the negative performance in August? And are there any underperforming sectors that investors should be cautious about?
Good evening, Will. Thank you for having me. So what I would say is that, what we've seen in the equities market is essentially an extension of a lot of the sentiments that we've seen from investors generally, since, well, I wouldn't say the start of the year, but, after maybe the first 2 months of 2024. So in January and February, we saw, strong positive sentiments driving the markets up. However, we saw, that trend, do a U-turn in the subsequent months, as we started to see policy developments like the monetary policy rates, rising significantly. We saw rates within the fixed income market also rise significantly. So that generally made equity assets, less appealing, if you will. And as I mentioned, we saw that extend. And then furthermore, in addition to that, what we saw was that there were, underwhelming financial releases from a lot of these corporates during the period, and that's also triggered significant sell-offs. If you remember, large cap stocks like MTN and Nestle, which essentially showed, not so positive financials, caused a lot of sell-offs in the market. So I think that has remained, and it has caused a tepid performance in the market so far. So going forward, over the last month in August, you will see that there's been some positive sentiment, although the market generally closed in the negative zone on a month-to-date basis, like you pointed out. It closed minus 1.22%. And that was largely because of the oil and gas sector. That was largely because of the industrial goods sector, right? So the industrial goods sector fell by 13.1% over the last month, and that was a drag generally on the whole bourse. But it could have been worse, if we didn't see the significant gain in the oil and gas index, the oil and gas sector that gained 22.44%. So I would say that those are the drags and the pulls that has shaped the market's performance over the last month. But to answer your question directly, it's been the industrial goods index really that has seen the most hits in the market.
Also, do we see this trend continuing, especially given the strong year-to-date performance? Do you see, you talked about underwhelming corporate earnings. Do you believe that certain stocks or sectors might be overvalued at this point because the year-to-date is still high? And should investors be wary of potential corrections, or should we be seeing a bullish trend in the horizon?
So if you look at the first half of the year, we're in the second half of the year now. During the first half of the year, a lot of the investors, they relied, largely on technical analysis, right? Particularly due to the, very uncertain market conditions that, were prevalent during that period. However, sentiment, is shifting more towards fundamental analysis, right? As we, go into Q4, we're in Q3 currently, so this time, people are looking more at, the fundamentals, So, and if you look at the current valuations across the stock exchange, they are, generally, attractive prices with, substantial potential upside. So, we believe investors, will incorporate these fundamentals into their decisions as they approach the market. In addition, there are certain factors which we feel should also help to jolt the market. So, for example, we're seeing that, that high yield that we're seeing in the fixed income market is not sustainable. So, it's inching down a little bit, and that might, sort of, draw investors' eyes more towards the equities market. And, also with, actions that, corporate actions that we're seeing from a lot of these counters on the stock exchange, within the banking space, I think investors are taking a wait and see approach, in terms of how their financials come out, and also some other corporate actions which are generally expected across the market. So I think, as we close out the year, when we consider all the things I mentioned, as well as historical analysis, seeing that, towards the last quarter, we start to see some picking up in activity, in the equities market. I think we should still close in the positive, but investors should still remain cautious because there are also some counters which from a valuation standpoint are quite expensive. Oando has been a stock that has been driving a lot of daily gains in the market, especially in the month of August. So if I'm looking at a PE ratio, that's a price to EPS ratio at about 7x. That's quite expensive when you compare it to the average of the market. So I think investors should be quite cautious and be selective in their trading or investing decisions in the market.
So I was going to ask you what investors should be looking at, investors that want to capitalize on the market's upward trend that we're looking at now. The strategies, you mentioned some of the strategies, but what other strategies would you recommend, and what stocks should they focus on? Are you looking at growth stocks here, value stocks, or perhaps should they diversify into other asset classes at this moment?
Okay, so if you are focusing on the equities market, which is what we've been talking about, in terms of what constitutes your portfolio, as I mentioned, I think investors are going to be looking more towards the fundamental approach rather than a technical approach, which we saw was prevalent in the first half of the year. So looking at companies that have strong earnings growth this year, ones that have their return on equity in excess of their cost of equity, or their return on equity greater than probably maybe 12% to 15%, seeing double digits, average industry average margins. Dividend is also a key factor to consider. So, dividend yields, probably higher than 5% is also something to look at. And as I mentioned, the PE ratio is also a key factor to consider. If you look at the market, for example, let's just take the oil and gas space, alone. Within the oil and gas space, I mentioned that Wando has, significantly high PE ratio, but some of the other players within there, are, still relatively more attractive. And what we're seeing is that because, there's significant bid on Wando, we're seeing this contagion effect, if you will, spilling over to, some of the other oil and gas players like Eterna. So I think what investors should do, without, giving out straight up financial advice, please consult your financial advisor, is to, essentially look at these stocks from a fundamental analysis perspective before they go in, and not just let trends alone and, unsubstantiated drivers to push them to make their investment decisions.
Okay, you got all slippery there for a moment, Mustafa, because you're trying to avoid giving that financial advice. But it's right, seek financial advice from an expert before you make a decision. But still staying within the oil and gas space, Japaul Gold recently secured a $20 million investment commitment from Global Emerging Markets GEM, and that's a global investment group. And this funding will be provided over 3 years through a share subscription agreement where Japaul Gold can issue equity shares to GEM as needed, and the money will help Japaul Gold complete mine acquisitions and start gold, copper, lead, and zinc production in Nigeria, in different parts of the country. With Japaul Gold's transition from oil and gas services to mineral exploration, this is a significant shift. How do you assess the risk and opportunities associated with this transition, especially in the context of Nigeria's evolving energy sector?
Japaul Gold's financials, I think is a different story from the whole energy story in itself. But if we assess the Japaul Gold's numbers, we'll see that, like you rightfully mentioned, it reflects a company in transition, really. We saw, reduced revenue. However, the company managed to post, a profit, and, it still shows, in terms of their ratios, some operational consistency. Of course, the negative cash flow, from operations is something to look at, something that raises a red flag in there. There's significant amounts of liabilities, especially the short-term current liabilities, and that highlights liquidity risk. The net current position indicates liquidity risk. And, that could, be a factor for investors to consider. However, it is important to also take into consideration their focus on asset sales and their equity capital injection activity. So we've seen that from GEM, which will be crucial in essentially sustaining their operations and improving their financial stability as they go ahead to try to achieve some of the aims which they've touted that they wanted to do. So, with this GEM, Japaul Gold, securing 20 million USD capital commitments, and, it's through this share subscription agreements. And this funding, is essentially to be used over a 3-year period to support the mining operations, including gold, which, is quite substantial in the northern part our country, although Japaul, has operations, as they mentioned, in other parts of the world. So, them, having this shift and this injection, is important, I think. The company, focusing on offshore support for the oil and gas industry, is now shifting to mineral exploration, aiming to be a major player within that space, within the mining space for gold and, critical mineral resources. So this 3.4, this 20 billion USD commitment, I think is quite significant for them. If you look at their portfolio, they have mining leases, in gold, as I mentioned, copper, lithium, and others.
Okay.
It's quite significant in terms of their asset base. So I think there's a significant potential for the company, but the liquidity issues are still something to pay attention to.
Okay, we also want to wait to see how that impacts the shareholders, funding, the performance in the company as well. We'll wait to see that. But before we take a quick break, just hold your thoughts there, Mustafa. We're going a quick break. We want to see what happened this week. The Nigerian Securities and Exchange Commission, SEC, has approved 2 crypto exchanges, KIDAX and Busher, under its Accelerated Regulated Incubation Program, ARIP. And this approval, in principle, gives them official status as crypto trading platforms in the country. In addition, the SEC admitted 4 digital asset firms, Trovotech Limited, Wrapped CBDC Limited, Dream City Capital, and Housing Exchange NG Limited to test their technology under the Regulatory Incubation Program. The capital market regulator says it is reviewing more applications for approval and emphasizes that these current approvals are steps towards full registration, granting legal recognition to these platforms. So we'll take a breather now. When we come back, capital market is still with us. Stay tuned. Welcome back. Now, according to the National Bureau of Statistics, recent data released for the GDP numbers, the domestic economy maintained its growth trajectory as the real GDP grew by 3.1% year-on-year in the second quarter of 2024 from 2.9% in the first quarter, driven largely by the services sector. Mustafa Lau, head of investment research at Investment One Financial Services, is still with us virtually to help make sense of these numbers. Mustafa, Nigeria's GDP growth seen an improvement from both the same period last year and the previous quarter. How would you assess how significant is this growth in the context of Nigeria's overall economic recovery, especially when compared to other African economies?
I think, I don't think these numbers are something to celebrate about yet. I think, we still have a lot of work to do. Over the last year about or so, the Nigerian economy has shown, mixed performances across the different socioeconomic indicators. The economy is essentially just adjusting to the challenges that are posed by exchange rate depreciation, the energy subsidy reforms. Currently, as we speak, there's a fuel scarcity, isn't it? Macroeconomic instability has persisted, and that has, hindered growth. It's eroded prosperity, and so on, increasing unemployment. So these factors have remained. We're seeing about 3.2% in real GDP growth. But when you consider the base effects, it's not really something to get excited by, is it? So, this time last year, which is, the base year which this current growth was measured against, that was when we had, scarcity of fuel. We also had issues with regard to Naira. Naira wasn't readily available. There was the Naira scarcity issue. So then, Q2 last year was a period whereby we had economic slowdown, and then measuring from that onto this year, we're expecting to see a significant growth. Even better than what we currently posted of 3.2%. I also want to consider the oil sector, right? You see that the oil sector this time last year, it was also in a negative position. It was in the red, but now we've seen that grow. So if we just dissect the numbers, we'll see that the oil sector, which I mentioned, saw a significant increase of 10.2% year on year, and that was what essentially helped our numbers to grow to the level of 3.2%. However, if you look at it on a month-on-month basis, you see that the oil sector actually saw a 10.2% decline on a quarter-on-quarter basis, right? So, there are still those issues that we're dealing with in our economy generally in the upstream, with regards to oil theft, pipeline vandalism in the Niger Delta, and those things that have also reduced investment. So, we do know that the NNPC declared a state of emergency in oil production, but there's still struggle in order to meet demand, whether for export or for local consumption. So, the oil sector's growth on a year-on-year basis due to the low base effects from last year was not helped, significantly. Within the non-oil sector, growth remained about steady, 2.8% year-on-year growth in Q2 2024. So, you can attribute this modest growth, partly due to the slower performances in the services sector. Services sector grew by 4.4% on a year-on-year basis. But when you compare that to to Q1 2024, which is the previous quarter, you see that it's a slowdown because in Q1, the services sector grew by 5.4%, right? So, there has been, a lot of negative impact, from challenges in the ICT sector. There was the NIN SIM linkage issue. Of course, that also slowed down the ICT space and subsequently the services space. Additionally, in the financial services sector, we saw that growth slowed in that sector as well, and of course, when you think about it, you think about the high interest rate environment, right? And the potential crowding out effect from the government's aggressive borrowing during the first half of 2024. So this is essentially the story around our GDP performance, and in terms of comparison to SSA, I think I think what is best to do is to assess your your balance sheet, if you will, the resources that you have, and compare that to where you should be. So we're definitely not there. However, what we expect to see is that as we go into as we round up the year, we should see that GDP growth should slow in the third quarter. Why? Because that base effect that helped the second quarter growth is not as significant. The oil sector, which has been a major driver of growth, in the last two quarters, is likely going to experience output slowdown, because of the high base effect, as I mentioned. But if we also look at the non-oil sector, there's been modest improvement, yes, but the issues that caused us to see a slowdown on a quarter-on-quarter basis in Q2 are still persistent. Effects of the CBN potentially cutting down rates, I think that's going to have a bit of a lag before it has significant positive effects in the economy. So generally, I think we shouldn't necessarily celebrate yet. If you look at the different sectors of our economy, all these issues still persist, which are hindering growth. Agricultural sector as well, which is a significant part of our economy. There are insecurity concerns in the food producing regions, and there are also harvest issues. So I think this is essentially the story around our economy and its growth.
Okay, when do you, in your opinion, Mustafa, do you see Nigeria? Do we see Nigerians benefiting from any growth in the GDP? When do you think Nigeria can come out of this slow growth that you're projecting? Because you said the factors that are contributing to the low numbers are still persistent. When do you think we can come out of this, and when do you think we can start benefiting from any significant growth?
I think so. If we look at some of the factors which are highlighted in my earlier submission, you see that there are factors with regards to energy supply. There are factors with regards to exchange rates. there are factors with regards to monetary policies, right? And, of course, and the consequences that come out of that. If these factors can be dealt with, right, when we talk about exchange rate reforms, right, what caused it to come about is because of the dearth of FX within our economy. So from a revenue standpoint, the government really needs to, improve in that. And, let's start with our oil sector, boosting production, being able to benefit from, beneficial global crude oil prices. Then as well as structural issues, generally that cause high inflation. So if we are able to deal with, power, electricity supply, some of these reforms from a monetary perspective and from a fiscal perspective, and also the structural issues, then I think we'll be on our way to essentially seeing growth, which is befitting for a country that's growing at about 2.7% in terms of population on a year-on-year basis.
Thank you so much, Mustafa Lau, Head of Investment Research at Investment One Financial Services. It was great having your perspective on the show.
Thank you.
Now, still on Nigeria's economy, as the country navigates a complex landscape of economic challenges and opportunities, stakeholders have come together to dissect the forces shaping the country's future. And according to the Chief Executive Officer of the Nigerian Economic Summit Group, NESG, Mr. Tayo Aduloju, Nigeria is on a growth trajectory. However, he believes that food inflation must be tackled to ensure sustainability. Mr. Aduloju made this known at the private sector dialogue on the state of the Nigerian economy in the first half, organized by NESG.
Looking at macroeconomic numbers for the first half of the year, the big message is whilst we are now seeing movement in terms of growth, 3%, 3.1%, signaling an improvement. So we are on a growth trajectory. Lots of work is required, especially because the sectors that historically were drivers of growth have slowed down still due to macro pass-through risks that were encountered due to macroeconomic volatility. More importantly, to signal going forward that government needs to double down on the big structural reforms. Agriculture and food security remains priority number one. If we do not tackle food security and bring down food inflation, we will not be able to really bring down overall headline inflation.
And that wraps up this edition of Capital Market. Remember, whether the market's bullish, bearish, knowledge is your best investment. Thank you for watching, and I'll see you next week. I am Will Ibong.